Good morning, everyone. How is everyone today? Great, thank you. My name is Jacob Gaffney. I'm the editor-in-chief of HousingWire, and I've been doing that for about 9 years. I've been living and breathing the housing and mortgage finance space and working really hard to extend the responsible home ownership to Americans. I agree with everything Mr. Twilliker said. We have been a media sponsor for this event for 3 years now, since its inception, I believe. And it seems that the best way, we've learned a thing or two, and we think that the best way to really fundamentally get at the issues is to begin with a panel that explains where we are headed. So we know that people are struggling. We know Americans need help. We know that we have the minds in this room that can get the help to them, but we need to know where we're going. Not what's happened yesterday, not what's happening today, but what can we do about tomorrow? So we have with us two very great minds who have put together a wonderful presentation each that is unique to this forum, and I hope that you capitalize on the information. I'm very impressed with what they've done. I'm discussing with them. Again, I'm the editor-in-chief of a media company, so if you're looking for press, I urge you to come talk to me. If you are not getting your message out, I urge you to come speak to me. That's why I'm here. So thank you. I'm going to start with Chris, who's going to take it away. Go ahead, Chris.
Great. Thanks, Jacob. So our task is to set the stage for the day. We only have a few minutes each, so I'm going to try to do this at a pretty high level. And so just to highlight, I'm going to make five points that I think are key issues going forward in the housing market. The first one is that from our view, the national homeownership rate has probably found a bottom somewhere around 64%. I know Ron was just saying that he thinks it's still going to fall, so I'm not going to say that this is bet the house on this, but going back to the beginning of 2015, the homeownership rate has come out every quarter just around 63.5%. One quarter it was down, and the last few quarters it's up. And so we think because the fact that it fell from 69 to 64% was a function largely of two factors. One was 10 million homes lost to foreclosure, and the other was the devastation of the Great Recession. Both of those things have passed. Those headwinds have largely abated. There are many other headwinds facing home ownership, and so we think it has found a bottom. It's found a bottom, though there's a different landscape for renting now than there was. There are more families, more individuals with higher incomes who are renting, more families with kids who are renting, more older people who are renting. So even though we're coming to a bottom of the decline in home ownership, there's a new landscape for renting. Renting is a very fundamental aspect of our housing market, and going forward, about 36-37%, if we're at the bottom, of household growth will be renters. And the last decade, we had household growth among renters of 1 million a year, twice the rate of household growth for renters at any other point in our history. And so essentially unsustainable at that level, but we're looking forward slower but solid growth for renting. And so I think we had to bear in mind that has some impacts in terms of affordability. If we have lessening demand, that could help create some slack. But I think there's lots of ways in which we haven't solved the ability to provide low and moderate income rental housing, even with lower demand, that will remain. So one fact, I think we're coming to stability in the home ownership rate. Fact number two, we are woefully undersupplying our housing market. So the orange bars in this chart show you cumulatively over the last 10 years how much housing have we added. And if you go back over time, it's always been between 14 million housing units a year over a 10-year period. At the peak of the housing boom, we were adding almost 17 million a year, so we overshot. But if you look at what's happened over the last 10 years with that blue line, what's happened with housing starts, over the last 10 years, we've added 9 million housing units, which is much lower than any other time in the post-war period. We really have not been adding very much housing. You can see we're now back to about 1.2 million starts. That's low. That's not much above what a low point would have been in previous recessions. And so this question about why aren't we providing more supply of housing, I think, is a fundamental issue going forward. And another aspect of that is what we're supplying. So this chart shows you the distribution of single-family homes by size. And the orange line in the middle is the one I want to draw your attention to. That's the number of homes under 1,800 square feet. So back in the early 2000s, we were building between 400 and 500,000 of these starter homes a year. It fell down to about 125,000. Last year was the first year it moved up again, but still well below 200,000 homes a year. We're not building starter homes at a time when the millennial generation is coming of age, and we would think there would be an increase in this market. I don't have a slide, but I could also tell you a story about what's happening in the multifamily side. If you look back in 2001, 40% of new apartments rented in real terms, adjusted for inflation, for under $850 a month, which is roughly what the median renter can afford. Now, that's less than 20%. And back in 2001, 15% of units rented for more than $1,500. Now it's 40%. So what we're building in the multifamily market is very high end. Why are we doing that? We're doing that because we have a lot of high income renters. That's been one of the big shifts in the rental market. But we're also doing it, I think, because it's harder and harder to build at the affordable level. So we're seeing this issue of supply both overall and particularly at the affordable level in both single family and rental housing. And I think a key question for housers is, how do we build more affordable housing? Affordable with a small a, affordable for people in the middle of the income distribution. And it's a regulatory issue, and we'll hear about that today. It's also a design issue. How do we design simpler housing? How do we design communities that are more cost effective? And it's a technology issue. How do we bring new technology to bear? So this question about what does it cost to build housing is a critical one. Point number 3. Income inequality is a fundamental issue behind a lot of what's happening in the housing market. We are housers, and so I think that focusing on the supply side of housing is important. But just to remind us why we're in the situation we're in, this chart shows the trends in real incomes in different quintiles. And so 2 things are evident from this. One is just that widening of the income inequality just since 2000 or 1999 is shown in this chart. So since 2000, real incomes at the top part of the distribution are up by 5%. At the bottom, they're down 12% in real terms. So a big part of the driving force behind housing affordability is the fact that incomes have been falling in real terms while costs have been going up in real terms. Now the good news is you can see all those incomes are turning up. And so I think that's good news in terms of the demand side. We're seeing the tight labor market actually starting to affect incomes. And so that's the good news. The bad news is you can see that widening has happened, and that's contributing again to the affordability problems. If house prices are being driven by people at the top end, while people at the bottom end are seeing their real incomes fall, that's why we're seeing this widening band of housing affordability. So income inequality is a fundamental fact behind a lot of what we're going to be talking about today. All right, point number 4. The issue of affordability. Ron talked a lot about this. This chart shows the number of severely burdened homeowners and renter households going back over time. And you can see through the first part of the decade, both of those numbers, renters and owners, were increasing rapidly in terms of the numbers of severely burdened, that is paying more than half their income for housing. The homeowner number has come down. It peaked at around a little over 9 million. It's now down a little over 7 million. And so we've made some advances in homeowner affordability. I wouldn't cheer too loudly about those advances because they came largely to the fact that people who were most stressed lost their home to foreclosure. And the other reason why it's down is because people who are most likely to stretch are first-time home buyers. And so we're not having as many first-time home buyers. But overall, we're not seeing as much distress among homeowners. But if you look at the renter line, those numbers were similar for a long period of time, and renters left to homeowners behind have gotten up to 11 million. The last 6 years, as we've seen income growth pick up, that number has stabilized. And so the headline would be this year, the numbers of severely burdened renters is down by 100,000, followed a year when it fell 300,000. But that's a false headline if you say, well, where were we in 2000, where we had about 7 million? So as Ron said, we have 4 million more. And I think what we're saying in our work is that we've established a new normal. So it used to be 39% of renters were cost burdened. Now it's in the neighborhood of 50%. We're down to 47%, but it's not coming down well below that. It would take 18 years at the current rate for the share of renters who are cost burdened to get back to where it was in 2000. And that 18 years assumes that the kind of economic situation we have now where incomes are rising would be maintained. So we've established a new normal for housing unaffordability that I think we have to fight against accepting that this is the level we want to be at. Okay, my last point. The Joint Center is known for our demographic forecasts. Again, in thinking about the future of the housing market, overall levels of household growth are important. And so what this shows you is the trend in actual household growth. We show a 3-year rolling average because the annual data, as you can see, that dark line is pretty noisy. But compare that to the orange line, which is the projection the Joint Center made a year and a half ago for where we think household growth would go. Now you can see that orange line is actually above what had been the average in the 1990s. And the reason for that is A, the millennial generation is the largest young generation in history. They are coming of age. They have the potential to drive a lot of household growth. And B, if you look at what's happened since the recession, there was a lot of pent-up household formation waiting to happen. My 24-year-old is going to move out of my basement, and when he does, we'll get to that orange line. Now, the thing I want to point out here is that what we've been watching this, and we were seeing go through 2015, that actual line was getting up towards that orange line, and it's turned down the last 2 years. Why is that? The economy is firing on all cylinders. Incomes are growing. Why would household formation be slowing? At first, I didn't believe it. That if your prior doesn't match the data, question the data. But now we see that this is the housing vacancy survey, the current population survey, the American Community Survey, all are showing a slowdown in household growth. So I'm having to question my priors. I don't know why it's slowing down. I have two theories. One is I think this rental affordability issue is slowing down household formation. I think it's getting harder for people to launch, and that catch-up that we expected isn't happening. And the other issue is immigration. A big part of the reason why we see that number getting to 13 million over the next 10 years is because the Census Bureau was calling for higher levels of immigration going forward. And mind you, most of that immigration was coming from Asia, not from Latin America. The last year or so, that immigration, even before the new administration, had turned down. And I think what we're going to see in next year's numbers are going to turn down more sharply. So immigration is a big driver of household growth. And I think what we're seeing is that impact on overall household growth is going to affect the housing market and the ability of housing to drive the economy as well. And so I think what I'll show you next are some of our projections for households. Bear in mind, they're assuming we get to that orange line. And I'm now questioning whether or not we're going to get to that orange line. So this is a chart showing both the next 10 years and the 10 years after that. The green part is the overall level of household growth, and the part in blue I want you to focus on is how much of that net growth is going to be accounted for by people of color. And over the next 10 years, it's about 72% of net household growth is among people of color. African Americans, Hispanics, Asians are going to drive household growth. And so as we think about the housing market and the solutions we need, we have to think about a housing market that works for communities of color. And then as we look out over the next 10 years, household growth is going to slow because the baby boom generation is actually going to die. Thank you, Doug. No easy way to say it. I sometimes say they're going to exit stage left, shuffle off the Mueller, they're going to die. And so when the baby boomers start to die, household growth is going to slow, and at that point, 90% plus of household growth is going to be people of color. And so I think we have to keep this in mind as we think about our country, our society, and our housing market going forward. And the last point, Doug touched upon this, is the aging of the population. This shows you the population in 5-year increments, households now, 10 years from now, and 20 years from now. We make a lot of fuss about the millennials. And if you look in the middle of this chart, you can see 30-somethings and 40-somethings having pretty strong growth over the next 2 decades. Good news for rental markets, good news for entry-level home ownership markets. But you can't help but look at the right-hand side of this chart and what's happening with older households. We're going to go from having 30 million people over 65 now to 50 million people over 65 in 2035. That's 1 out of every 3 households. We're going to have a doubling of the households over 80, from 8 million to 16 million. Most of those households are homeowners in suburban houses that are not accessible for people with mobility issues. They connect only through cars. How are we going to house those older folks safely? And really what we want to do is get them out of those houses into houses that are more suited for them and free up that housing for the next generation of families. And so this question of how do we make housing that's there to foster that turnover is a really important issue. I don't know if I've gone over, Jacob, but let me stop there and turn it over to Paige.
Yeah, that's good. Paige?
Sure.
And we'll take
Thanks,
questions
Chris.
after Paige's presentation.
Okay. I'm going to talk specifically about the rental housing market, and particularly a study we just completed for the National Multifamily Housing Council and the National Apartment Association. So it was a team of 4 researchers, 2 professors, one at Indiana University, one at University of San Diego, and then 2 of us on the consulting side of the industry. I'm more on the investment side, and we had a housing specialist who also worked on this project. And so our goal was to forecast rental housing demand through 2030 for all 50 states and for 50 major metropolitan areas in the country. Results of the study, 4.6 million new multifamily units will be needed by 2030. Keep in mind this is only about 16% of the housing market. This is specifically the institutional part of the rental market. It's buildings with 5 or more units. That's a larger part of some markets than others. This Detroit, in fact, has more units, less than 5 units. So, so this is just one part of the housing market. The forecast not particularly aggressive. We're forecasting about 1.3% growth. That's lower than the 1.9% growth we've seen over the last 9 years. Really just as interesting as a forecast of some of the trends we started seeing as we were developing it. And what we came out with was a deeper understanding of what's creating demand in the housing market. And it's going to be a very different demand in the next 14 years compared to what we've had over the 2 decades. So I just wanted to hit 3 key issues on why demand is going to be so different going forward than what it's been. The first, as Chris has already mentioned, is the aging of our population base. So you'll see here in these bars, this is change in rental households by age cohort. You'll see 2000 to 2010, 2010 to 2020. We have growth coming in from different parts of the population. On the institutional side, we tend to think of renters as the under 35. In fact, they're only about 1/3 of our rental market, but certainly have accounted for their proportion of growth going forward. If you look at that last bar on the right, you'll see the big blue chunk at the top. That's that 65+ age group, what Chris had just told us about the baby boomers. The baby boomers are going to account for 65% of new rental demand going forward, a huge difference from what we've seen in the past. You'll notice the blue and the red at the bottom completely missing. That's our under 35, who we traditionally think of as our renters, completely missing from our net new demand for the next 10, 15 years. So a very different demand dynamic going forward. We looked at it by region. The metro area and state differences are huge. So when we look at the 65 group, for example, they account for a very large percent of demand, particularly in the Midwest to Northeast part of the country. The Gen Z, so think of these as the under 25, they're really young renters, very concentrated in the South. So very different dynamics going on throughout the country. The second major issue that I want to talk about is immigration. Immigration is a policy issue. It creates a lot of uncertainty in our demand. Our forecast is similar to what Chris was talking about 1.4 million new households per year. But there's a lot of uncertainty in that, and it's created by this immigration issue. So the yellow bars are births minus deaths. So we get population growth by 2 things. One is births minus deaths. The other is immigration into the country. Historically, births minus deaths, so natural increases are half to more of our population growth. If you look going forward, those blue bars start to actually outpace what our births minus deaths. So we become more and more dependent on immigration as we go forward because of our aging population. You see those yellow bars coming down going forward. That's again the aging issue. We have fewer births, so we are more and more dependent. If we don't have immigration, that 1.4 million new households turns almost into half. We get less than 1 million new households, so it's a really critical issue and a big unknown in our forecast going forward. So we looked at that by region. So you may think, well, we hear about these immigrations a lot with the border states. We hear about it in Arizona and California and Florida. In fact, those states have a lot of migration from other parts of the country. They also have a younger population. They get more births in those areas. So our regions of the country that are most dependent on immigration for growth happen to be those aging markets in the Northeast. They don't get migration. They don't have as many births. They are more dependent, and we have more uncertainty and more downside risk in those Northeast markets on our demand forecast. The other part of immigration, again, as Chris already gave us heads up, is that new housing demand is almost all non-white. And in fact, a very large percent of housing demand going forward is going to be from the Hispanic part of the population. That has all kinds of implications for household size, for income, for all sorts of dynamics. One is home ownership rates. We actually did not assume that we bottomed out on home ownership. It certainly has been coming up recently. We think there's a lot of reason that there's going to be downward pressure on home ownership rates going forward. One is the immigration issue. immigrants tend to be renters. So those blue bars there on the left are rentership rates for immigrants. The red is domestic, so much higher renters on immigration and much higher home ownership rate by ethnicity and origin for white alone. We have much lower home ownership rates on these parts of the population that are really growing. The third thing that I want to point out is affordability. And affordability is a very complex issue, as we've already been hearing about throughout the conference. One issue is low income. Almost a third of our renters are earning less than $20,000 a year. That's particularly an issue in the southeast part of the country, where even more than a third of renters earn less than $20,000. That's a part of the market that's really overlooked by institutional investors. You see very little institutional investment in this part of the market. But we think of even on the high side, so where we have high incomes, we think of that often on the coast, New York and California. We have a different affordability issue right there, and it's a housing cost issue. So even though we have high incomes, we have even higher cost of housing. It happens both on the rental side and on the ownership side on many of these markets. And it actually is affecting migration trends from some of these states. So you may be seeing some of the news. We're seeing construction, certainly in the news. We're seeing vacancy rates going up. We're starting to hear now of rent rates coming down. And you think, how can we need more housing? We're seeing vacancy rates going up. The new construction is really focused on the high end of the market. So we split up vacancy and rents by buildings that are in the top 20% of the rent rates in the market and build in the rest of the market. You'll see the blue bar is those top buildings in terms of rent, and vacancy rates have actually been going up in that for quite a while. That's the effect of lease up on new construction hitting the market, and the rest is vacancy still coming off. We looked at this also by rental growth. And the interesting thing is that rental growth is actually higher in that orange segment, and we split it up by deciles. So actually the lowest 10% of rents are facing the most rent growth right now. So the new construction is exacerbating our affordability on two issues. First of all, they tend to be higher rents, so a larger part of those markets have higher rents where there's a lot of construction, but it's also bringing rents up on the bottom part of the market and making those less affordable as well. And then finally, we looked at supply restrictions, and this is a project that we're continuing to work on right now. Supply restriction index is a factor of land availability and also policy issues, and these blue dots are 50 metro areas that we looked at. So we looked at how much is supply restricted, both by policy and by natural restraints, and what is the affordability of rental housing. So that's the axis on the bottom. So the further right you are, then the less affordable housing is. And in fact, we find that the more supply is restricted, the higher our housing cost is and the more unaffordable it is, even when you take incomes into effect. So I'm going to leave it there. The full study is under weareapartments.org, and you can see details of all 50 metro areas there, as well as some details on the national forecast. Thanks.
Thank you, Paige. So I guess in short, I wish we had better news. I will say on the mortgage side of things, there are some improvements worth mentioning. Alternative credit scoring is coming more and more into play. Technology is improving marginally, so the access of mortgages, maybe not to these households quite yet, but it is growing, and political will to try to tackle the student loan crisis, which goes back to the millennials that you were discussing, is part of the discussion. So there are some advancements. I don't want everyone to get so depressed so early, but I do want to open the floor for Q&A. There are some mic stands if anybody wants to ask a question, or if you could just raise your hand and shout it out. If there's any questions for our panel. Go ahead. Yes, sir.
Yes, the gentleman earlier spoke about 5 fundamentals. One of the questions that I have, 2 questions. I'm sort of perplexed by the studies that he stated that was undersupply of housing units. How do you tell a city like Detroit, what do you say to a community like Detroit that has abundance of foreclosures and blighted houses that there's an undersupply? That's number one. And number two, when the minorities, you mentioned a slide about minorities drive the household growth, will drive the household growth. The question that I have, how do you tell a city or community like Detroit, if there's no employment, and that's the key to home ownerships, how do you tell potential minority homeowners who are unemployed and unskilled to help drive that market? Thank you.
2 very good questions. And obviously, like the first question about why it is that, what do you say about supply issues in Detroit, where it's not a question of a lack of supply, but in the sense of abundance of supply? And the actual, very good point that there's not a single housing market in the country, very different housing market conditions, and Detroit is not San Francisco or Boston by any means. And so in Detroit, you need a whole different set of supports. And I think the supports you need are, how do you invest in the existing stock? We got a tour yesterday of some work that's going on in a neighborhood here in Detroit where about 3/4 of the homes are occupied, about 1/4 aren't. And they're trying to invest in getting those homes that aren't occupied rehabbed and resold. And the issue there is, after you buy them, rehab them, the value of the money you put in isn't the same as the value. So you need to have some subsidies to close that gap. But by doing so, you'll stabilize that whole neighborhood and bring those values up. So I think, you know, when we talk about the supports we need in a place like Detroit, it's how do we have the supports we need to reinvest in the existing stock, and think about how do we uninvest in areas where there isn't any demand and alternative uses for that land. So a very different set of supply responses in Detroit. And on the issue of home ownership, you're absolutely right. I mean, I think, as I pointed out on the slide around income inequality, part of this is a housing problem, part of this is a jobs problem. And so the first thing is people have to have a stable income in order to be able to be stably housed in any event, whether it's home ownership or rental. And so we have to have a labor market side of the equation as well. But what I would say is that, you know, to the extent that you have a very cheap housing stock in Detroit, there are opportunities to get people into homes where the cost of ownership is probably even less than the cost of renting. And so we ought to think about workforce training programs, but also savings programs and other efforts to try to get people prepared for home ownership.
I can just add on the job formation issue. We have another study that we do that just tracks current economic growth. So we just want to see where economic growth is happening right now. And it's a balance of growth and some long-term stability issues in those economies as well. And the interesting thing that's coming up in the last couple of years, and we just updated this last week and saw the same thing, is parts of the Midwest are coming up ranking really highly in some of those states. So I'm in California. San Francisco is coming down in those rankings because growth is actually slowing in San Francisco. Now, part of it is the labor issue, but part of it is an affordability issue. And so Indianapolis, Kansas City, Columbus, Ohio all came up ranked highly. They're lower cost. The states are much more fiscally healthy than some of the other states. California, for example, not fiscally healthy. And they're able to attract jobs. And when you have an $80,000 job, a tech job in the Silicon Valley, where that's the median household income, it doesn't really add to your household income or your GDP growth. When you put that in the Midwest, where your average household incomes are closer to $45,000 to $50,000, it starts really popping the growth numbers. And we're seeing that trend now as employers start to look for places where they have good schools, where they have good educated employment bases. We're seeing parts of the country here really come up ranking quite highly compared to what we've seen over the last 5 or 6 years.
Thank you. Yes, ma'am.
Yes, could both of you comment on the role of multifamily ownership, so condos and townhouses? Because Chris pointed out that we're seeing such a low number of ownership units that are below 1,800 square feet. And that used to play a big role in our market. In Minnesota, not so much at the current time. What do you see there in terms of future trends?
Yeah. Paige, you want to go first? Or you want me to go?
Go ahead.
Yeah, so I think we tend to equate home ownership with single-family housing and renting with multifamily. And they're two different issues. It's the form of ownership and the structure type. And there's no doubt that we're seeing a resurgence of the desire to live in the cities. And I think there's a whole host of reasons why we ought to be encouraging higher density living for having more compact and efficient forms of urban development. So one would hope that to the extent that home ownership is an aspiration of people in their life course, that having high density home ownership is one of the options that is available to people. We've been looking to see if we're going to see that trend pick up as the millennial generation hits their 30s. And we haven't seen it. And so I think, Mary, it's a bit of a question mark for me why we aren't seeing more of it. I've heard that in some states, I'm not sure how common this is, that there are liability issues around condo development that have chilled developers' interest in building condos because of the ongoing liability after the home is occupied for defects in the home. I don't know how widespread that is. I know that's affecting some markets. But for me, I think it's certainly a viable and important option, and it's a puzzle why we haven't seen more of it to date.
There's some interesting work that's come out of the urban planning world. It shows the cost, the stress of building very low density housing, and it is amazing to see the stress that it causes on a municipality compared to doing more urban dense housing, and it is interesting to see it's still coming up as, as the single family market construction starts to come up.
Thank you. Are there any other questions? We're approaching the end. I do think back to the gentleman's earlier question as well. I do think there's a question of financing that can help reach those what we call the underbanked areas. It's been difficult, to say the least, to get a large portion of the society back involved with dealing with financial institutions, especially because there's an overarching feeling that the financial crisis burned them the first time around. So I know in Dallas-Fort Worth and working with Univision there, we are trying very hard to reach the Hispanic community. And one thing that comes up a lot is whether or not the 30-year fixed, FHA 3.5 down with mortgage insurance for your entire life, if that's a good solution for first-time home buyers. So we are seeing progress again on those fronts and trying to find good financing options to try to help deal with these problems. So with that, if there are no other questions, we will probably wrap up this panel and get moving on to the next one. I want to thank everyone for your time this morning. Thank you very much, Paige and Chris. It was a pleasure. Thank you.